Okay, welcome everyone. We'll start our lesson today. Today we'll do our third session on global finance and strategy. My name is Anjum Satar. My email addresses are here in case if you need me, if you have any questions, so please drop me email. I'll get back to you as soon as possible. So we'll start our lesson 3 on global finance and strategy. Is OTHM level 7 diploma in strategic accounting and finance. So before starting our session today, we'll first recap what we learned during our previous lesson, and we'll look at inductive content for this unit, what we're supposed to learn. So unit 3 level 7 global finance and strategy, and criteria is the path. So first lesson we discuss about understand the concept of globalization. So I discuss with you what is meant by globalization. I discuss with you different strategies we can make for globalization business. We discuss about ethnocentric, polycentric and geocentric strategies, and we discuss investment process in a global business. Then we discuss about impact of the global environment, global business and environment. We discuss national and multinational businesses, and I mention you micro and macro environment as well within. And then second lesson we discuss about different strategies, value statement, name, organization, which we discuss about various ways which we can increase the value of the organization, how we can enter into the global market, and we need to look around the financial perspective. So be able to evaluate the financial consequences. I mention you different consequences, what's happened in the credit crunch, what are the consequences of there can be a lot of the cost involved in the foreign currency. We discuss about the various others. So we discuss the mode of entries as well. So when we're looking and want to do the global business, we need to look around in the financial perspective. So today lesson we'll go through LO5 and 6. Explain the sources of finance. Sources of finance is very, very crucial decision in terms of the company. So because if you borrow money from one source, at that source, we need to look around what are the needs for your finance, why you raising the finance. Is it for short-term purposes, medium-term purposes, or the long-term perspective? So because the reason, if you make a long-term contract and you need only few days that money, because of course your cash flow will be increased because you will get the money from your debtors. So we need to look around that factor very closely when we'll make the decision about the sources of finance. So which we'll go through. Then we'll look around the risk. Risk is mean the probability of something occurring. Risk normally people think is a bad thing. Risk can be have a positive and negative impact. So there are the different techniques we can go through. Few we'll discuss you in our lesson today, and we'll look at of the cost of capital. We can use various approaches as well. So those will help to measure the risk. One of them is a hedging. Hedging means to protect ourselves against the foreign currency. When we are dealing in a global business, so there is a big issue about the currency fluctuation, so where we can lose the money. So we have been given the case study within assignment as well, which we'll go through, and plus. Okay, anybody any question up to now? So please ask me if you have any question. So any question, so please ask me. So we'll go through now. Okay, so if we look under finance, so which we are doing, let's quick we'll go through and then we'll start our proper session. Global finance strategies are lessons there, so please go through. And if we look the learning outcome, what we're supposed to do, so books there as well, so please go through those. And we look the inductive contents we are doing today is LO5, which is sources of finance, definition of finance, internal and external sources, how we can raise the money, which we'll discuss finance, risk associated, how we can. Learning outcome 6, which will go through different model, weightage average cost of capital, weightage average and the foreign currency risk. Those will look, excuse me, we'll go through these, all today lessons. So please, if you have any question, just ask me so we can, if anything you not get me, ask me. So risk can be, we can avoid risk. We're not doing business in international. What are the chances, mitigation of risk? We can transfer risk by getting insurance or involving someone, or we have to accept risk. There are the risks, we need to acknowledge them. So that's all we need to. Okay, we'll start. Welcome everyone. So is a lesson 3 on global finance and strategies, LO5 and LO6. Please, I went through with you initially, just inductive content. So first we'll discuss about the strategy. So always need to be looking, what is your strategy before you make your decision. So what really you want to be, the determination of long-term goal and objective and enterprise adoption course of action and allocation of resources. So allocation, if you have a short in resources, you need a sources of finance. So guys, I mentioned you in the previous lessons as well, we need 3 M's. So when we start any business, we need 3 M's. So what 3 M's we need? We need manpower. It means we need workforce. Yes, we say workforce. So we need workforce, we need money. Yes, we need finance. So we can say we need money, finance, and we need material. Material mean we need assets. Yes, different sort of material. Those that come, it depends upon the nature of the business. So 3 M's we need. So 3 M's we need to be focused, and always we need these, when we'll start any business. So next our area of discussion now, we'll go through the sources of finance. If you need a money, where we can raise the money. So in a business world, we have a different sources of finance, we can use it. So if we're looking the sources of finance, short-term source, and the long-term source, and we're looking the finance for the small or medium enterprise, and then we have one other source of finance is Islamic financing is becoming popular as well nowadays. So we need to look around here. So short-term finance is lease, can be for short, but normally lease is clustered as a long-term. So maybe it's depend upon the period. If it's less than a year, normally we cluster as a short-term. So then we're looking the long-term sources, choose between the source, or sometimes we can divide them instead of short-term and long-term, maybe we can divide them into medium-term. So further slides which we'll go through. So what is a corporate finance? Why we need a corporate finance? It means the corporation. Corporation mean organization. Corporation mean is a multinational company. Corporation means the LTDs. Corporate business is a registered business, which is a Corporate Act, Corporation Act 2006 is govern the companies. So we need to look around those rules as well. So financing decision is one of the main decisions facing financial manager. So financial manager make the decision about the finance for the company. You want to expand the marketing campaign, but you need the money for it. If you don't have the money, how you will? So you want to increase the sales. So it's a common, we have an objective. If we'll advertise more, we'll sell more. So the managers need to look at the main option and consideration involved. So first we'll go through debt. What is meant by debt is something which has to be repaid. So you learn guys in financial accounting, if you ever attempt that subject before, so we call it liability. Liability is a legal obligation which we have to pay in future. So we call legal obligation. So is a debt. Yes. So debt can be short, medium, and long term. In the previous slide, we divide into short and the long term, but we can divide into medium term. So when we're looking the short or the medium term debt financing, so trade creditors. What is meant by trade creditors? So what is meant by creditors? Creditors mean the people to whom we bought something, but we not paid the money yet. So if we if we are buying or purchasing our goods, so we are getting on credit, so that's called the trade credit. So that is the one source of finance. Bank credit facility, if we can getting bank credit facility, like it can be credit, like can be overdraft as well on the basis of credit. Bank can give us credit. Bank loan is for a certain period of time. Normally loan is normally come under the medium or long term. Not normally. When we're looking, overdraft is come under the short term. Debt factoring, we have a debt. So we can we have a debtors we can sell to. Debtors mean the people to whom we have to receive the money. We can give the invoices to someone and we can receive money against it, or we can discount the invoices. We can sell those invoices in open market. The debt collector or debtors or the company, those will deal the debt, so they can receive the money from our customer, and we can give them invoices, and we can, if it's £100 we're supposed to receive from our customer, maybe we can raise up to £80. So £80 quickly we can get the money, and £20 each invoice will lose it. So every £100. So we need to look around what are the costs and benefits there. Hire purchase, yes, we can hire the thing on hire purchase agreement, which is quite popular when we need, like a car on hire purchase, HP. You maybe heard the short abbreviation. Leasing, I have two types: finance lease and operating lease. Finance lease is mean the asset is day first is on your title, like a car. If you buying on the finance lease, day first is the logbook will be on your name. So if it's operating lease is means the car, the logbook won't be on your name. It will stay the company name. You will be only the user, like a rent. You're living in a rental house and you carry on paying the operating cost, or it's called operating lease. So trade creditors, finance obtained from the supplier of goods and services over a period between delivery of the goods and the settlement of the account. So that's a trade creditors. We can look around. Bank credit facility, overdraft facility, which I mentioned you earlier, for the short period of time. Like, we supposed to receive money at the end of the month, but on the 20th we need some cash. And in our bank account, our business bank account, we have a shortage of money, and we can use bank overdraft for 10 days. So always is it good to be meet the certain quick requirement of the business, because it's happening. Loan can be a medium or long term. So normally loan can be 5 to 7 year. Finance obtained from bank. Loan can be various companies, but normally financial institutions. Debt factoring, raising immediate cash based on the security of the company debtors. Debtors mean the people to whom we have to receive the money, accelerating your payment from the customer. So that's, debt factoring. We can use this debt factoring techniques to improve our cash flow. So that's quite crucial, debt factoring. Next, we're looking the invoice. Anybody any question up to now? Please ask me if you have any question. Invoice discounting. Invoice discounting is other technique to raise the finance. The purchase of selected invoice, advance immediate cash up 80% of the face value. So like I gave you the example of £100 the invoice which we received, that's called customer invoices. So customer invoices we're supposed to receive money from the customer. We sold goods on credit, so that we can improve our cash flow, and we don't need the money, or we can raise the money. We can give the invoices 80% of the value of the invoices we can receive. Okay, hire purchase is usually make down payments and sign commitment to the series of months of hire charge over the specific period of time. At the end which the legally title passes to the user. So we need to look around. That is called a hire purchase agreement. Leasing, a commercial arrangement whereby an equipment owner conveys the right to use the equipment in the return of the payment of the specified rental over a pre-agreed. So that's we need to look around this, closely in our organization. That will help, to improve the cash flow, so we can struggle sometime and we can use the leasing techniques to sources of finance. So guys, that is quite useful. So if anybody any question, so please any question, carry on writing in the side box, in the chat box. So I'll carry on replying you as well. So characteristic of long-term debt. So when we're looking the long-term, what is the long-term, short-term, medium-term? Some people, it's no hard and fast rule, but according to less than a year is a short-term, 1 to 3 years, 5 years we maybe called up to 5 years, or even 10 years is called medium term, and more than that it can be clustered as a long term. Whatever the period, you can divide short term, medium term, and long term near to your industry, because every industry is a different requirement, so we can specify to one industry. So over 10 years, but not more than 30 years, lender or the creditor who debt are subject to the specific repayment. Lender have no control over the borrower other than the loan agreement. A rate interest is payable normally. It can be fixed or variable depend upon agreement. And the interest is charged for the profit and treated as expense in the corporation tax, and usually, so whenever you borrow the money, you need to look around that you need to be very strong in terms of the tax laws. You need to be look around at the opportunity cost. You need to look around all other costs which will go through further. Usually secured, fixed and floating. The capital is committed to be a project for the long period during the circumstances could change. So we need to look around the advantages, determining of our borrowing. So we're looking the long term debt. Mortgage. Couple of you, maybe you have a mortgage. Mortgage is clustered as a long-term loan. Term loan for 5-year term, 10-year term. Bond is a piece of which is normally can be secured. The bond have normally the long-term maturity. Bond can be secured and unsecured bond. Debenture is sort of the loan instrument which we use. Convertible loan stock. We have a loan. This loan can be convertible into shares. Sales and lease back. Yes, we can sell it. We can lease back it. That's carry on coming in, and that's the part of the long term. So mortgage obtained the security of specific property, repay the loan by the installment at the rate of interest, fixed or variable. Arrangement fees we need to pay. Trustee is appointed to watch over the right of the lender. So we need to look around the term loan. The loan is negotiated on the security of the fixed asset and repay loan at the rate of interest. And information on the past financial and operating performance is supplied, and the lender charge the cost of the investigation and arrangement of the loan of the borrower. So we need to look around bond. Long-term contract in which the bondholder lend money to the company. So pay the bond owner a series of interest known as a coupon payment. Coupon payment is a little receipt attached with the, you may be, couple of you used to be National Saving Investment Certificate. There used to be attached little coupon in it. It means you can take the coupon, you draw your interest, and that the maturity you can get full your money back, but you can coupon is you can carry on getting interest regular as well, or you will get lump sum at the end. At the maturity of the bond, receive a specific principal amount. Okay, bond may be regarded as IAU. So these can be traded in the secondary market and the dealer on the stock market. Secondary market is not traded the first time. It means it can be traded, like you go shares first time is traded in the stock exchange, and then next time you can even buy from the various brokers. So that's meant by, okay, debentures, secured bond, fixed and floating charge against the firm. Bond investor may be willing to the lower coupon payment demand and reassured that their money will not be exposed to high risk. so may place the risk reducing restriction on the firm. So that's we can look around. Risk reducing restriction limit on further debt, dividend level, limit on the disposal of asset, and financial ratios. We can look around these. Convertible loans, the loan which we can being life as a bond, debt, and usually pay the lower rate of interest. Holder have an option to convert their stock to the fixed number of ordinary shares at the predetermined rate. So according to maybe face value, not the market value. Usually the several years between the issue date and the possible conversion date. So maybe we'll say after 5 years, if you want to convert the loan into the shares. So we're supposed to pay money, but after 5 years, we can pay you money or you can buy our shares. So instead of, so on shares, you can earn the dividend as well. So that's meant by. So we can look around the sales and lease back. Sell asset, usually property, to the financial institution, and the seller give up the ownership right to the property and will then arrange to lease the premises from the new owner and transfer of ownership with the retention of the right to use for a specific period. So thus we can look around. Equity. What is meant by equity? As the word indicate, equity means the equity shares, equity capital, which is in the sole trader we call capital, but in limited company we call equity. Equity means share capital contributed the company by its shareholders. Okay, the key features of equity for there are no fixed charge, no repayment is required. Director have a greater control over the amount and the time the share are listed and can easily be disposed of. Okay, against the public issue is expensive and issue new shareholders is diluted. So if we are issuing more and more shares, it means the profit we have now divided by the number of shares issued. So the dividend per shareholders is dropped. Dividend are not tax deductible. Higher the proportion of equity can increase the overall the cost of capital. So we need to look around those. Equity finance, reverse venture capital. Venture capital means 2-3 companies come together, and there are many venture capital companies in the UK, so they can fund various projects. So private placing can be alternative investment market. We can look around other quoted company. So all these we need to look around closely to look around and measure the risk and reward of each source of finance as well. So reverse reserve, if we have a reserve, we can raise the finance internally. So the reserve we can use it including the retained profit, because the retained income is not our profit, the profit is the shareholder. So we can use providing, actually the shareholder is the owner of the business, providing the main source of new capital for the company. So less costly than issuing share and free source of finance and more attractive than the loan. So that is good. You have your own money, you can use it for certain project instead of you go and borrow more money from outside, and then of course you can pay more dividend on this if you generate more to your shareholders. So provide equity capital to the small and growing company, faster development of small businesses for the variety of reasons, tap into innovative research and development, and may develop a new source of supply and gain access of new markets. So private placing is well-established companies can widen their shareholder base without going to the stock exchange listing, arranged through the stockbroker issuing house, and which buy the shares and then place them with the client. So that is also is very popular sources of finance. So provide a market for the shares to the company or too young or small qualified for the benefit from full listing. So quoted companies may be required such large amount of new capital decided to go public by issuing shares through the stock exchange. So we discuss about, okay, always guys, when we looking the debt, and normally we say debt and equity financing, debt normally is cheaper than equity because you're borrowing the debt from, and that can be loan you can get maybe 4 or 5%. But if you are issuing the shares normally the dividend more than 10%. So we need to look around. But of course, if we earn the profit, we'll pay. So we need to look around both. This it has. But if you're issuing too many shares, you will lose the control. And when you lose the control, it means can be kicked out from the management position, because the shareholder have a right in AGM, annual general meeting, to select the new director, the management for the company. So that we're looking the sources of finance. When we're looking the sources of finance, we need to look around the risk versus the return. So the money you're borrowing for the purpose, your return should be higher than the cost which you're paying. Normally in business we say higher the risk, higher the return, but we need to be measure the risk. Is it risk is acceptable? Like, think about the Bitcoin. If you're investing money, it can go up. It's been from 18,000, 15,000, 5,000 to in few hundred now. So we need to look around this. Is how is because nothing is behind the scene is secure. So weighted average cost of capital is a technique which we use where we're looking the cost of equity and the cost of so when we're looking dividend model, DVM, dividend value model, which we can look around a capital asset pricing model. So these are two techniques when we'll measure, and those will help to measure the risk. And so cost of preference share we're looking as well. Cost of preference share normally is come under the debt financing. So cost of debt, we can look around irredeemable, convertible, redeemable, and bank loan. So these are all come the cost of debt. So how much is the company cost of debt? So we look around different theories. We can theoretical consideration, the main capital structural theories itself, the way in the chain, the gearing. Gearing is what is meant by gear. If you drive your car in a high gear, we call it financial. Higher the ratio of gearing ratio, it means higher the risk in the business. If you borrow long term, you have a very, very high gearing. Normally people say it between 60 and 40. So 60% debt, 40% equity we need to issue. But if it's very even, it's not hard and fast rule, but we need to look around. So capital structure impact the firm's weighted average cost of capital. The theory consider the relative size of the following two opposing forces. The first, debt is usually cheaper than equity, lower risk, tax relief on interest. So because if it's a debt, you're paying interest on it is expense, and thus you can minus from the profit. So it means you're reducing your profit, you're saving on the tax. So we need to look around that. And the second, increase the level of the debt, make equity more risky. So increase level of debt make equity more risky. So of course, equity becoming more risky. So fixed commitment paid before the equity. So first of all, if you have a lot of debt, it means the shareholders very little money will be left to pay them. So finance risk is there. So increasing the gearing in form of debt, increasing the cost of equity would increase the weightage cost of capital. So if you're increasing the debt with the net effect on the equity, overall weighted average cost of capital can be increased. So according to this theory, we need to be look around. It's not increase, it's supposed to be decrease, or it's supposed to be minimized, or it's stay the same. So what has the greater effect on the reduction in the weighted cost of capital that caused by the cheaper debt? So the increase in the weighted cost of capital caused by the increase in the financial risk and KE in the cost of equity. So we're looking here that traditionally explain the lower level of gearing. Equity holders see the risk increase in the marginal as the gearing rise. So the cheaper debt issue dominant, resulting in the lower weighted average cost of. So we need to find the way we can get the loans cheaper. Think about the base rate is not 0.75. We can get the loan on 1.75 with 1% top of your base rate, or we can get 2%, we can get 3%, we can get 5%, we can get 8%, even we can get 15%. Depend upon your credit scoring of your company or individual business owner. Depends, when we're discussing about the nature of the business as well. Equity holders becoming increasingly concerned with increased volatility in their return, and the debt interest paid first. Always debt will be paid first in case of the company need to pay to equity holders. The dominate the cheapness of the extra debt, so the weighted average cost of state arise as the gearing increase. So at a very high level of gearing, the serious bankruptcy risk worries equity and the debt holder like. Both cost of equity, cost of debt arise with the increased gearing, resulting the weighted average cost of capital is rising further. So we can look around the cost of capital and the gearing. So cost of equity, cost of capital, and cost of debt. So cost of debt is normally the lower. So when the cost of capital is increased, so it will be increased. So cost of debt, cost overall weightage cost of capital. Anybody any questions? So please ask me so we can use it. WACC, which is we also learn in other units as well. So guys, please carry on. One great scholar, Miller and Maliani, he gave the theory and explained about an investor or the rational. They require the return of equity is directly linked to increase the gearing. So as the gearing increase, the cost of equity increase in a direct proportion. So there is a direct relationship between if the cost of debt increase, the cost of equity also will be increased. However, there is adjusted to reflect debt interest is a tax deductible. So the overall cost of debt to the company is lower than the it's Miller and Maliani's no tax. So lower debt cost imply less volatility in returns for same level of gearing. So giving smaller increase in cost of capital. So increase in the cost of equity, KE, does not offset the benefit of the cheaper debt financing. Therefore, the weighted average cost of capital falls as a gearing increase. So gearing up to reduce the weighted average cost of capital, and optimal cost of capital is a 99.9% gearing. To demonstrate the following diagram, we can look around the value of the company and the level of the gearing, and the level of gearing and the weighted average. So this will help to be measure the risk. So in practice, firm may really found with the high level of gearing as the advocated Miller and Maliani because of bankruptcy risk is there, the agency cost is there, involved, tax usation. We can look around the impact of borrowing and the debt capacity, difference in the risk tolerance level between the shareholder and the director, restriction on the article of association, which is mean the registered when we register the company into a company house, we need to write the article of association, who will be responsible for what, that can be restricted to because we have a registered capital, that can be because we can't issue more than. So as a result, despite theories, gearing level in real firm tends to base on more practical consideration. So key practical argument against the bankruptcy: as the gearing increase, so does the probability of bankruptcy. Shareholders become concerned, and this will reduce the share price increase the weighted average cost of agency restrictive in order to safeguard their investment. Lender and debenture holder often impose restriction condition in the loan agreement, the constraint management and the freedom of action. So we need to look around on the level of dividend. We need to look around additional debt can be raised and the management from disposing of any major fixed asset without debenture holders agreement. So this we can look around and we can try to be offset the interest charges. So borrowing and the debt capacity, high level of gearing are unusual because the company run out of suitable asset to offer the secured against the loan. The company with the assets which have active second-hand market and low level of depreciation such as the property companies. So high borrowing capacity. So difference risk tolerance level between the shareholder and the directors. So business failure can have far greater impact on the director than well diversified investor. It may be argued that director have tendency of cautions of borrowing. So we need to look around this. So next we're looking the risk, what type of risk and the capital structure. So key consideration when we borrowing the money, we need to look around ongoing service cost. So you're getting the asset, so you need to consider the ongoing service cost as well. Issue cost. Gearing, it means high gear, high risk. What is the gearing ratio? You learn in the financial accounting, that divided by equity. So optimal capital structure, what is available, tax rule, we need to look around, flexibility, we need to look around the cash flow profile, we need to look around the risk profile, we need to look around income, and we need to look around the theory. Traditional theories find optimal gearing level. Is looking the tax and the gear up as much as possible. Bankruptcy risk chained with the Miller and Malayani to give the similar result to the traditional. So practice statics, trade-off, pecking order and compromise. So we need to look around the agency effect as well. So there can be a various risks. So guys, when we'll borrow the money from, we need to look around the interest rate, we need to look around the opportunity cost, we need to look around the debt versus equity cost, we need to look around the short term, medium and the long term, and we need to look around the tax rule, we need to look around what impact will be on the overall organization, because that's why if you carry on borrowing, so how much is the asset we have, how much is we already borrowed. So ultimately you're going to put the risk in the company. So some companies are running on purely on the debt, but we need to balance them. So today we just run about, so there are some approaches which we can look around. Anybody heard about TARA and SARA approach, which is we need to look around, transfer the risk, we avoid the risk, we respond to the risk, or we can accept the risk. Exactly, we can share the risk, we can accept the risk, we can reduce the risk, and we can accept the risk. So all we need to be look around different approaches to manage the risk, which we can use. Risk can be, what type of the risk can be? Risk can be economic risk. Yes, so we need to look around, sometimes it can be political risk. Yes, that leads to overall business risk. We can look around operational or operating risk in the business. So we need to look around not the impact or the business, or we'll reach at that point where we need to close the business. So today we learn about the sources of finance. Sources of finance, we can divide it into three major: short term, medium term and long term. We discuss about majorly debt and equity financing, or you can get various other sources which we discussed today. And I discuss you with different risk and different risk model and techniques. We discuss about weighted average cost of capital, we discuss of Miller and Malayani model, we discuss about the traditional views about and we discuss about overall impact on and the gearing and the cost of capital. So that's all we need to look around, and we need to be look around, are you a risk taker? You can transfer the risk, you can try to be minimize the risk. Always look the risk, how much is the risk in the same thing in a global business, and we can use the hedging techniques to protect the risk, which further we'll go through in the next lesson. Anybody any question, feel free, drop me email. And all guys, hope so I will see you those are listening and watching this recording. So please try to attend this lesson, this unit, and we will be we'll do our session next week on Sunday. So please try to attend and have a nice time, have a nice weekend, and hope so we'll speak you all. Thank you. Bye bye.